Hello, I'm Miles from Propertunities, and today I am joined by Kwasi Affum, who I originally saw at one of John Corrie's Property Fortress events where he was talking about financial regulations in property. Now, Kwasi was talking about the minefield of regulations in property, and quite frankly, it was quite scary because there's a lot of things to bear in mind. So today we'll be talking about that, talking about how you can invest or how you can raise finance in a financially compliant way. Kwasi's got quite a formidable background, so he's worked for the likes of Goldman Sachs, Deutsche Bank, JP Morgan, and most recently Barclays. He's also got his own company called Viable Consulting, which is a specialist consultancy focused on regulatory change management, strategy and execution in investment banking, asset and wealth management. As well as that, he has his own portfolio of HMOs, so he's quite a busy man. So, welcome, Kwasi.
Hello, thanks for having me.
Pleasure. Tell us, so give us a bit of background behind your journey into what you do now.
Yeah, so I guess my journey, like a lot of other people, began after uni. I studied engineering, nothing to do with anything that I'm involved in today. But after studying engineering and realizing I wasn't going to become an engineer, I ended up working in financial services. I had a number of different roles, but I spent most of my career working for the companies you mentioned, but within various operations and project roles across the various investment banks. I was unfortunate enough that over the last 11, 12 years or so that I've been working has coincided with the post-financial crisis world we live in, which as a result has led to a whole range of different financial regulations coming out. It meant that even when I wasn't in a regulation role, I was having to deal with a lot of regulations that were coming out. I ended up specializing in regulations ultimately. It's actually been the only growth area in financial services in the last 10 years, so I've been very lucky in that sense. But so I've spent that time working a number of roles, analyzing regulation, implementing regulation, coming up with how to make regulations commercially viable, as well as how to provide a competitive advantage for the firms that I've been employed by through regulation. So yeah, in a nutshell, that's what I've been doing. I've worked across multiple global regulations in various countries: Australia, Russia, South Africa, UK, Europe, North America. And so yeah, I've been heavily involved in the whole regulation stuff for a while now, it feels.
So when I saw you on a panel at John Corrie's event, I think there was a panel of about 5 of you, and I think you're the most vocal one because there is so much information out there and so many things that people just don't realise they have to abide by some of the rules and regulations. So it was, as I say, I mean, being a property investor myself, there's a lot of things that scared me a bit, which is why I always have this interview.
I think one of the things that I realised when I started getting involved in property to begin with, I was going to networking events and meetups and seeing videos on YouTube and people promoting training and coaching sessions, etc. But one of the things that struck me, based on my background, was that there wasn't a lot of communication about the regulations that impact these activities. So people were talking about, you should do JVs, they're great, which they are, but then skipping the whole things like, okay, but actually it's a regulatory minefield because you're taking people's money. And that's ultimately what you're doing, you're taking people's money. And when you start doing that, investor protection rules kick in and it's a whole minefield. So it was interesting for me just coming fresh eyes and just seeing all the stuff that was happening, seeing people at networking events promoting investment opportunities and things like that, and I was just a bit surprised, should we say. So my goal wasn't to scare anybody or to frighten anybody, but just to give a bit of information that they may not have been aware of, really.
I suppose the basis is, would I be right in saying the FCA, the Financial Conduct Authority? Yeah. So tell us about it. They regulate?
So the FCA are the main regulator from a financial conduct perspective. So you remember probably that we used to have the FSA, the Financial Services Authority, and they were really predominantly preoccupied with looking at financial services, companies involved in financial services. what happened is that the responsibilities were shifted slightly, so the FCA was created out of the FSA. But what the FCA does is look at financial conduct. So it's not just looking at banks or financial institutions, it's looking at financial transactions and financial conduct. And this is where a lot of property investors come into it, because their actions and their activities involve financial transactions. And well, that's what the FCA regulates. So if in the course of your business, you're involved in financial transactions, taking people's money, making investments, that type of activity, then something along the lines will probably be regulated by the FCA.
Mm-hmm. What does it actually mean to be FCA regulated? What things do you have to go through at a very top level?
So I guess there's different levels, and I should clarify at one point that when you're involved in property, the buying and selling of property is not regulated by the FCA or by anyone for that matter. That's unregulated activity. You can buy and sell property as you want. What happens is that once you start involving creative financing techniques, so if you are soliciting funds or inducing people to get involved in your deals, trying to encourage people to invest with you, or trying to encourage people to part with their money, or just getting creative in terms of how you're financing the deal, how you're going to source the funds, that's when the FCA get involved. And so in terms of what it means to be regulated, that doesn't make you regulated, but your activities will be under FCA jurisdiction. That means that they would have set out guidelines, policies, and regulations that you have to follow. And if you don't follow them, then you'll be censured by the enforcement team. So it's not quite the same as being regulated or being a regulated entity whereby you register or you have to register with the FCA or you have to get authorization from the FCA. This is a bit different. This is where your activities come under FCA supervision and you have to comply with the outlines that they've given in terms of how you perform these activities.
Okay. And is there an intrinsic cost of being FCA compliant? Presumably there's the cost of potentially employing someone or paying a consultant to make sure you're compliant. Are there any other costs, or how do you quantify it?
Yeah, there are definitely costs to compliance. It's relative though, and it depends on what your activities are. So if you are doing highly regulated activities, you may need to hire a compliance person in-house, or you may need to fully outsource your compliance to a firm that is FCA authorized and approved. In that case, it'll be based on a commercial agreement between you and that compliance handler. But for the best part, I would say that, to be honest, most property investors doing the type of things that I've seen, observed, and I'm doing myself would not necessarily need to go to that full extent. It could be just to give the spectrum. On the one hand, it's about being fully compliant, hiring a compliance officer or outsourcing compliance. On the other hand, more probably, it's about having a set of policies and following those policies. Policies could be a series of statements around how you do things, so how you promote your deals, the steps that you go through to promote them, the what you have to do in order to promote the deals legally, that's a policy. And then you just follow it. So if you know that if you have outlined, for example, that you have a certain forum where you attract investors, you have a database where you approach them, etc. As long as the database is compliant, you post on the forum in a compliant way, you just follow that process and then that's it. And there's no cost. Post setting up the policies and the procedures, there's no cost subsequently, it's just about following them.
Got it, okay. Now I'm conscious that it's quite an analytical profession to be in. There's lots of acronyms that can confuse people, so things like KYC, AML, things like angel financing. I mean, our audience are kind of varying levels. They could be very big amateur property investors. They could have done it for years and years. So can we go through some of those? So,
yeah, sure.
So what's AML, for example?
So AML is anti-money laundering, and this really derives from the Money Laundering Act, which came into force in 2007. And ultimately, the AML regime is about making sure that the funds that you're receiving, the funds that you're using, are clean, aren't the proceeds of crime. They haven't been derived from any illicit activities or criminal activities. They haven't been brought into the country legally, that type of stuff. So that's really where AML comes into it. AML is about analyzing the information that you're given. It's about looking at the bank statements and seeing that actually these funds may have come from a bank account in Iran. Well, that's a red flag because Iran is sanctioned. Mm-hmm. So AML, or you may see that actually in order for the funds when you see that the funds arrived in the account this morning, and you ask for source of wealth, which is a part of AML. So you ask for the source of where the funds have come from, and they might show you another bank statement, which is where the funds came from. But they also got into that account yesterday. And then you start to build a picture, and that's what AML is. It's about building a picture and understanding where this money has come from, and is that money really clean, and should I be using this money for the purposes of my business?
And I would guess that kind of segues quite nicely into KYC.
Yeah. So KYC is know your customer or client or counterparty, but KYC is probably happens before AML. So KYC is a point in time exercise. It's really about identifying and verifying who you're doing business with. Here you want to make sure that you've obtained things like their identity, so that you know that they're who they say they are. Something like a passport would do that. You've also verified something. If they tell you they from the UK, you verified the address, via something like a bank statement, so you know that they actually live in the UK. If they're from abroad, you might source another document to prove that they actually live where they say they are. It's really, KYC is about just knowing that the person you're doing business with is who they say they are. And that's mandatory by law. Otherwise, you may be doing business with someone who has stolen the identity. They could be pretending to be someone else. So it's really important that you know who you're doing business with upfront before you start doing business with them. And that's what KYC is about.
Got it. I suppose the types of people you'll be dealing with, so some of the other lingo, high net worth individual, sophisticated investor.
Yep.
How would you quantify a high net worth individual? Is there a specific figure that they have to be worth once they're classified as that?
The general guidance for high net worth is about 100k in salary. But it varies, and it's really a risk-based approach. It depends what you're doing and who you're targeting. But generally speaking, about 100k in salary is typically considered high worth, or also about $500,000 in investable assets is considered high net worth as well. So from a financial services perspective, if we're looking to do business with somebody and they have to be high net worth in order for you to do business with them, you're really looking to see that they're either earning 100k a year, or, and it varies, it might be an and as well, they have about $500,000 in investable assets. So that's really where you would sit with a high net worth individual. I think the sophisticated piece is also another subjective aspect to it, but here it's about the person having a level of experience in what we are actually talking about. So if the agreement is that, or if what you're looking for is investors into a property deal, a sophisticated investor should be somebody who has some kind of experience in that space. They would self-certify sophisticated, so they would call themselves sophisticated, but the regulations say that you have to really sort of look at that and assess it from your own perspective to make sure that you agree with it. And if you find any information that contradicts what they've said, that's what you have to go with. So ultimately, yes, sophisticated investors is more about their knowledge, their experience, and the investment field or in the asset class that you're looking to invest in.
But is it quite a grey area, because there aren't kind of rules that people have to, well, there isn't a specification of exactly what. So I mean, could I be a sophisticated investor if I've never invested in money, but I bought shares in a company?
I mean, you're right. So it's not. It can be a bit of a grey area, and this is where a risk-based approach comes in. So from a prudent perspective, a lot of the reputable companies, if you came to them and said that you have lots of money in shares, or you're very sophisticated, experienced in investing in equities, stocks and shares, and want to invest in property by a joint venture, that would make you a sophisticated investor, because you have no knowledge and no experience in the field that they're doing business with you in. So you would still be, technically you'd still be naive in that space, because they could tell you anything about property and you wouldn't know, because you have no experience in that field. If they're for shares, then you'd be a very sophisticated investor in shares, because you've been doing it. And I think, and this is where a lot of the misunderstanding comes in, because there's subjectivity to these rules, you can kind of bend them to suit your own needs. But if there's enforcement action, the regulator will look at the most conservative interpretation, not the most aggressive interpretation, and this is something that people often forget.
So, talking about bending the rules, what are 5 things that people are doing that effectively mean they're breaking the law right now when they're raising money to buy a property through any means? Yeah,
I mean, I think what I'll do is I'll talk about the main 5 things that people should do, and then maybe you can apply that and see if people are doing it or not. and breaking the laws. But the main things, from what I've seen really, and just from interpreting the rules as I've been doing over the last decade or so, the main things when you come to soliciting investment or promoting an investment opportunity, really the first step is about the financial promotion. So you need to be complicit with how you promote that investment opportunity to begin with. This means promoting it in the right way to the right people who are sophisticated enough, or so one approach is that you promote it to people who are sophisticated or high net worth, and you know that up front. The other approach is that the deal is authorized and approved by the FCA. And then the third approach is that you are an authorized person by the FCA. Those are really the only three ways you can promote deals. So it's always interesting to me when I see people making arguments for why their deal is fine and their deal doesn't meet any of those three criteria, because those are the only three ways that you can do it. So the first way is promoting deals. The second way is KYC, which we talked about. I think a lot of people don't understand the difference between KYC from a regulatory perspective and KYC from a business perspective. So doing corporate due diligence is very different to doing the regulatory requirements of KYC. The KYC I'm talking about, you do because the law requires it, as opposed to you do because you want to satisfy your business needs and business asks. So the second piece is KYC. The third piece is AML, which we also spoke about. AML, a lot of people maybe think that, I've heard things like just because the money is from a UK bank account, then it's fine. I haven't seen that written anywhere in the rules. I can see from a risk-based approach why you might come to that conclusion, but that's not the starting point. Just because the money is in the UK account doesn't mean it's fine. You have to analyze it and you have to think about it and then come to a conclusion. The other piece is really around, not similar to AML, but more about financial crime. So there are other rules around Proceeds of Crime Act, criminal activities around tax evasion, things like that. So, for example, you have to report if you see somebody performing actions which may be tax evasion, you have an obligation to report that. So you could be breaking the law if you observe and witness someone evading tax and don't report that.
Is that only if you're dealing directly with them, or say if I noticed someone down the street, they were I oversaw something on their phone and I saw they were non-compliant or they're breaking the law. Do I still have that obligation?
No, it's really where you're doing business with somebody.
Okay.
And so maybe that your JV partner, for an example, would be your JV partner is telling you that he earns £200,000 a year, but then he gives you his tax return, and his tax return only shows 100 grand a year.
Got it.
That's you facilitating tax evasion according to the law.
Okay.
Yeah.
Right.
The final piece, I say this is the final piece, but actually if I'm honest with you, I think this is the biggest risk to most people doing JVs, and this is around something known as suitability and appropriateness. So we've talked about the promoting of the deal, the KYC, the AML, the financial crime compliance, and this is about suitability and appropriateness. Suitability and appropriateness is about ensuring that the deal is suitable for your JV partner from their own financial perspective. And the second half of it is that when you're about to do the deal, you have to ensure that it's an appropriate time for them to engage in that transaction. So I don't think I've come across anybody in the property space that has told me that they're doing this type of thing. But effectively, what you have to do is, when you are assessing whether or not the JV partner can invest with you, you have to ensure, and you've already confirmed their high net worth or sophisticated and otherwise, but that's all a separate regulatory ask. For suitability and appropriateness, you have to confirm that the individual has the capacity, the risk tolerance, as well as knowledge, as well as experience in this field to make sure that it's suitable for him to invest with you. So you need to be able to prove that the investment is suitable for him. Not that it works for you, and again, maybe this might be a paradigm shift in thinking, but from a suitability perspective, if you are arranging deals, you need to be able to confirm that the investment is suitable for the person who is investing in that deal. And then at the point where you're ready to execute, and you take their money, you need to confirm that it's appropriate for you to do so at that time. So from when you said it was suitable to when you're about to take their money, they haven't started going through a divorce, they haven't lost their job, their circumstances haven't changed. You're obliged to make that assessment in between suitability and investment execution to make sure that it's still appropriate. So those are really the 5 things I think that property investors, specifically JV arrangers, should be aware of when they're doing deals.
I think it was possibly an analogy that you used, talking about. I mean, there are lots and lots of property investors, certainly in London. It's speeding. So lots of people do it, but they don't get caught. But they still do it anyway, in the knowledge that what they're doing is wrong. And sometimes when they don't know, they're speeding. It's similar to that. A lot of people are raising JV finance in a way that is technically breaking the law, but they don't know it, or they know it and they just think they'll get away with it, which a lot of people do.
Yeah, I mean, I think you're right. The speeding analogy is one I like, because everybody speeds. Everybody speeds.
I don't.
Well, you're the only one. Yeah. I mean, everybody speeds, but even the government have a tolerance on the speeding in cameras, so they know that everybody speeds. There's about a 10% variance. Maybe I shouldn't tell people that. But there's about a 10% variance in the speed cameras. I know this because the government told me themselves in a letter once when I complained about a speeding fine. So there's about a 10% variance. So that means if you're driving on a 30 mile an hour road and you're doing 32 miles an hour, you probably won't get flashed by the camera, but you're still speeding.
We're not condoning this, just to make you aware.
Yeah, to be clear, we don't condone any illegal activities, but this is the policies that the government have in place, whereby there's a variance and a tolerance built into the system, because they're aware that there's some kind of... But that doesn't mean that you should speed, because you can still kill somebody if you're going 1, 2, 3 miles over the limit. So, speeding is bad, and speeding can cause death, but people do it. And I use that analogy because I give this information. This is what I'm doing, is telling you what the speed limit is on the road. That's what I'm doing. I'm saying this is the speed limit. What people do with that information is up to them. If they choose to obey the speed limit, great. We'll have safer roads. Everyone will be happier. We'll be able to let our kids play along the sides of the street. If they don't listen to it, then they can speed. They can drive at 33, 50, whatever. They can go whatever speed they want down the lanes. But ultimately, there is still a speed limit. Whether they know it or not, whether they respect it or not, there's a speed limit.
What a good note to end on.
Exactly.
So thank you very much for taking the time to have this conversation. So Kwasi he has his own company, as I mentioned at the beginning, called Viable Consulting and Viable Properties. Tell us very briefly, what does that do, and how can people get in touch with you?
So Viable Properties is my HMO management company. It manages the properties in my portfolio, also manages properties on behalf of other people. It's effectively a la carte service, as I call it. One of the things that I believe is that the full service management approach is redundant. Nobody necessarily needs end-to-end management. People often need small bits, which is what I typically needed and couldn't find it out in the market. So what Viable Properties offer is we can do various parts of the management services for you. We have an automated process. So that's Viable Properties. Viable Consulting is really where I do my financial services consulting. I specialize, as we've been discussing, in regulatory change, impact assessment, and Viable Consulting is where I help people understand how regulations impact their business so that they can do the changes or implement the changes to make them compliant. My website, viableconsulting.co.uk. You can email me at info@viableuk.com.
Fantastic. Brilliant. Well, I've been Miles Bulloch at Propertunities. I've been joined by Kwasi Affum. Thank you very much for your time.
Pleasure was all mine.